So without further ado, let's kick off with our debate. I'm going to pass over to Paul to argue for the case for early stage growth strategy.
Wonderful. Shall I stand?
Go, stand. Pace.
Is that right? Sorry, teammate. So firstly, thanks for having me, and thanks for Cake, AWS and Stripe for putting on this very, very important and very, very serious debate that we'll be having. Hopefully you can tell from the tone. So as we all learned in high school, we start debates with some definition of key terms. So there's a couple of key terms in today's topic. The topic is, should startups prioritise capital preservation over growth? So the first thing, let's define startups. Now, everyone in this room might think they know what a startup is, but let's give it a very simple definition. A startup is a company that raises capital to grow at an unnatural rate to achieve hyperscale. So if a startup is a company that is aiming to achieve hypergrowth and hyperscale, it must grow. So sorry for those of you who are going to tune in for a four-person panel that was going to turn into real debate. That's the end of the discussion. I won't drop the mic. For the purposes of the audience who've come, we'll continue the discussion, but I think we can agree it's a bit pointless. The second key term for definition is prioritisation. So prioritisation doesn't mean to do something at the exclusion of everything else. It means to put it first. So if a company is prioritising growth, it doesn't mean spend at all costs like there's no tomorrow. It doesn't mean ignore your cost base or your financials or your sustainability as a company. It means to make sure that what you are doing prioritises growth, and then how you do it is really important. And sometimes the legends get a bit lost. So the legend maybe of Atlassian, a company that famously had no salespeople. You might think, oh, well, they didn't prioritise growth. Nothing could be further from the truth. It was all about growth. There was no way that there's Atlassian that we have today if it didn't prioritise growth, but it did it in a very capital efficient way. I can tell you, I've been in startups for 25 years. I've sat in 10 years of investment committees. There is not once that we have sat in an investment committee and said, oh, I love their capital preservation mode. Oh, that's exciting. Now, what we will do is we'll look at growth. So that's exciting. And then we'll look at how they do it. So if that's not top of their tree, they're not a startup by definition, and they're not going to achieve the outcomes that they want to achieve. There is another legend that gets a bit misunderstood, and that's the story of the tortoise and the hare. I made the mistake of giving Dan a preview here, so he's been forewarned. So a little bit like Wicked and Wizard of Oz, we're going to retell the story a little bit from the correct perspective, which is from that of the hare. The hare is the startup. The hare is the hero of our story. The hare jumps out to a lead and maintains its momentum up until something terrible happens. And for the first time, we're going to reveal some live footage of my friends on the wrong corner. Slow down, they said, you're going too fast. Don't prioritise growth. Don't prioritise speed. It wasn't just Dan. I don't want to point at Dan. Jesse's part of this as well. Cut your burn, cut your energy, cut your spending. Don't worry about speed. And we all know what happened. What happened, Jane? Even the lowly, slow tortoise overtook them, all because they got the wrong priorities. So I think that's the end of my 3 minutes. Thank you very much. I look forward to the outcome.
Very, very convincing argument, and thank you for correcting the record there, Paul. That was wonderful. So things may not be all they appear, but to correct her record, we're going to welcome Jessie to discuss the case for early stage conservation of capital.
Yeah, cool. I think it's telling that Paul stood up here and told us that, we learned in high school that you define the topic first. It's also very high school to try to win the debate at the definition level rather than engaging with the substantive argument. Bit of a high school move as well, but I'm going to challenge Paul's definition that the definition of a startup is a company that grows at an unnatural rate. I think for me, a startup is a company that has an insight and uses that insight to create so much value for its customers that it earns the right to capture some of that value in a profitable way. Because there is an infinite amount of product market fit to be found for selling something that's $1 for 90 cents. And you can achieve fantastic top line growth by giving people, very discounted groceries, or subsidizing Uber rides such that they were half the cost of taxis, and have a top line growth trajectory that looks fantastic. But eventually, when the desire to fund that startup and fund that growth dries up because investors can't see a path to profitability, you're going to run into a wall, and you won't have created a sustainable generational company. So on that revised definition, I have two substantive points I want to make. First, about how the value of staying lean during the search, finding product market phase of your startup's journey. And secondly, about how scrappiness breeds creativity. And that's a really powerful part of a startup's DNA. So as early stage investors, we sometimes talk about two phases of a startup's journey: the search phase and the execution phase. The search phase is simply when you are taking the cluster of unvalidated, untested hypotheses that you have about a problem, a solution, a product, and a go-to-market approach, and rapidly testing them and validating them or otherwise. And we find that in this phase, founding teams and especially founders themselves are best placed to test some of these hypotheses because they have the most information and the most vision inside their own heads. So it works really well when founders are owning the product roadmap and driving sales conversations. In this phase, it's actually quite powerful to be a lean startup because that means there's minimal comms overhead, minimal surface area for misalignment and conflict, and there's more doing and more and less talking. And sometimes startups that overhire and overinvest in growth during this phase find themselves kind of pulled out of that search phase where they're really refining where they have the strongest product market channel fit, and thrust into the execution phase where, because you've hired people, they have to go and execute against hypotheses that you haven't fully stress tested and finessed. And hiring certain kind of people can also lock you into certain ways of executing. For example, if you've gone out and hired a whole bunch of SEO marketers or a bunch of field sales reps, then you have to pursue that go-to-market strategy, even if you quickly realize it's a suboptimal one. So in this early phase, conserving cash by not hiring, going slowly as a founding team to rapidly test hypotheses, can actually mean that when you do decide to double down, you're pouring fuel on a fire that's already burning rather than something that is fizzling. Really brief point about creativity. So for those of you who don't know Afterwork, we're a first-time fund. We've been really lucky to raise $20 million from LPs who took a leap of faith in us. But the way that VC funds work is we draw 2% of the management fee from the fund. So you can do the maths. We're pretty capital constrained. And we didn't even have enough money to spend on furniture. So I actually groveled to this startup that sells furniture and says, look, I'll do a bunch of LinkedIn posts about your furniture if you give us some for free. And little humble brag, but our affiliate link has actually generated 130K of revenue for this furniture company. But we got really scrappy because we were cash constrained. And that means that we're more creative. That means that the founding team has dabbled in all parts of the business. And I think we're better for it, that we have that culture of creativity in our DNA. And that's what can happen when you conserve cash and don't overspend before you know what you're doing.
Compelling response. Thank you very much, Jessie. And now to represent a slightly later stage perspective on the growth mindset, we have Justine from One Ventures.
Okay. So I'm going to move past definitions and I'm really here to tell you, if you've raised capital, you've gone through all this effort to found your own company. You didn't do this just to sit on cash. You're here to actually put your capital to work. And actually, I'm here to specifically focus on the later stage, but it's actually dangerous to not focus on growth across the entire life cycle of your business. Once you're past the valley of death and you've found product market fit, let's say you're past Series A, Series B, every incremental dollar that you spend on your business is more certain to provide you a return than it ever has been before. You're no longer investing in high probability go, no-go situations. You're now at a point where you're starting to win customers and being able to actually see a return on a more certain basis for your business. The price you pay for not investing in growth is opportunity cost. Sure, it might be fine to save on a few sales reps, as Jesse mentioned earlier, but what does that actually mean in practice? So you've started to expand in your own market. You underbake your marketing team. In a fast-moving market, you're probably all working with technologies where substitutable technologies or competitors sit beyond Australia. And they could be coming from international markets, which are writing larger checks than Australia, and founders that are moving more aggressively than you are. You underbake that marketing team. You lose a major customer to another competitor. They might have locked them into a multi-year contract. And now that potential addressable market is lost to you, potentially forever if they have a decent product. If you underbake your engineering and product teams, you could lose your competitive advantage in the market in less than a year, I'd say, and that includes your reputation. So it's really dangerous to take your eye off the ball when it comes to growth. If any VC tries to tell you to slow down and focus on profitability, have a think about why they're telling it to you. Are they trying to balance your risk? Because you have the highest conviction over your business than anyone else in the room. Or are they trying to balance their risk? Because if you do slow down, what's going to happen when it comes to your next raise? Who are you going to be relying on for that next raise? And what does that mean for your bargaining power for your next raise? I just want to end up with a final point, particularly focused on later stage companies. If you are thinking about an exit in your future, that might be a unicorn scenario, it might be a sale to a trade buyer, whatever it looks like. In order to achieve a meaningful exit, regardless of the exit venue, you actually need to achieve a critical size. And in order to achieve a decent valuation, you need to optimize your exit multiple. Now, you can read all the financial textbooks in the world, all the different sectors, all the different countries. There are two factors that are most strongly correlated with a better valuation exit multiple. The first one is the size of your enterprise, and the second is your growth rate. So if you forget those two items, you forget them at your peril. And some of you might be sitting there thinking, that's cool, I'll turn off the tap now, I'll turn it on later. It is so much more difficult to try and reclaim lost ground than if you had just been focusing on growth the entire stage of your life cycle. So don't listen to these VCs telling you to slow down, because you do so at your peril.
Okay, so the reason the VCs tell you to slow down.
Dan, please. Dan, I said, as you can probably tell, these folks have done debating in the past. Dan tried to tell me he hasn't done debating as a student, but Chris from Amber corrected him to say that he does in fact have a law degree, so you should be fine.
He asked, I don't have a law degree. The reason we tell you to slow down is the exact opposite of that argument. It's not because we're putting our priorities first, it's we're putting your priorities first. Our priority is to tell you to swing for the fences. We've got a portfolio. If you go out of business swinging for the fences, we move on to the next company. That is the exact counter. You have your whole, you have one egg. We have lots of eggs in our portfolio. So when we tell you to slow down, it's for you, not for us. But we'll just put that aside for the minute. For the rest of us in the room who are a little bit bored by like storytelling and picture books, let's lift things up a little bit. We're going to do a little bit of community engagement. What's the number one reason startups have to close their doors? Why do they go out of business? Number one reason. Got no cash. Got no cash. What's the number 2 reason? There isn't a number 2 reason. No business says, "Oh, look at me, I got lots of cash, I got these great ideas." And no, I'm gonna shut the doors. You do not have a business if you do not have cash. All right, quick exercise. Everyone stand up. I'm gonna get a little bit of energy in the room. Stand up. You guys can sit down. You're too stupid for this. Sit down if you think money is easier to raise today than it was 12 months ago. No one? No one sitting? Okay, sit down if you think it's going to get easier. If 2023 things are going to turn around, cash is going to be abundant again. Anyone sitting? One sit at the back. Like I said, one brave guy at the back. Okay, now you can all sit down. So you're 100% right.
Could you stand back up again if you think it's much easier to raise with a really low growth rate?
Yeah, you had your turn. Yeah, you had your turn.
And you had the audience. You lost them.
The dot-com crash was clearly the biggest event in tech in our history. Now, what we're going through at the minute is not the same, but it's the second biggest since then. We all know the story of the dot-com crash, right? Like lots of money pumping into the industry, and then it fell off a cliff. Absolutely fell off a cliff. Yeah, not true. Didn't fall off a cliff. I mean, it fell by 50%, but the next year it fell by 50% again, and the year after it fell again. It took 3 years from the top to the bottom up post dot-com crash. How long till it got back above its peak? Any guesses? 5 years? 10 years? 15 years. Took 15 years post dot-com crash to get back to its peak. We are in for a long haul of no money being around. And if you think that like things are going to bounce back quickly, it's just not the case. So one of the things that's really important is the lag between public markets and private markets. It takes a long time. And if we look at what happened last year, we saw a lot of in public tech markets, we saw huge valuation decline. Why did we see that? It wasn't business performance going bad. It was multiple compression. And there are 2 really important points here. One is that if the slowdown continues and we see pullback in spend and there is actual performance reduction, then things are going to get a lot worse before they get quicker. But actually, the most important point is that during last year, a lot of these tech businesses were growing and growing very, very fast. And what happened to their valuations? They fell off a cliff. Why? Because growth is not the most important thing. Growth as your key metric is dead. The market spoke, and the market spoke very loud. Preserving cash doesn't mean going out of business. It doesn't mean investors don't like your story. It doesn't mean you can't continue to raise. It means being smart. It means being scrappy. It means being lean. It means being creative. It doesn't mean stopping your business and stopping growing. So if we put all this together, we know very quickly, without money, you're dead. Money's harder to raise. Not necessarily plowing it into stupid things doesn't mean you're out of business. There is just no alternative. We as a people, we dramatically undervalue optionality. Cash gives you optionality. It allows you to deal with bumps in the road as they come. It allows you to deal with hurdles as they come up. You don't have cash, you're out of the game. You can join these guys. I don't know what they're going to be doing. They're going to be, driving cars into walls or whatever it is. But you need cash to stay alive.
I'm going to write a response.
Do you want to write a response?
It actually pains me that I agree with a lot of what Dan said, which is interesting at a macro level. We've had a long relationship. It's never happened before. But there was a lot of that that was very sensible. But I think
Wait for the stupid joke. It's coming.
He's known me a long time too. Look, Dan, as you can tell, he's a doyen, what do you describe him as? A veteran, and he's got a bit of a short-term memory loss. What he forgot with that very, very eloquent and intelligent and well-researched and prepared piece was our side of the argument doesn't say, if you go back to the definition of prioritization, it doesn't mean spend at all cost. It doesn't mean ignore. I think what they've confused is the what and the how. If you're doing all this capital preservation stuff, a lot of it's really valuable. All those points Dan made are absolutely spot on. I'm going to get serious for a minute, sorry. But if you're doing it at the expense of growth, if you're doing it at the expense of forgetting what your ambition is, if you're taking the saying survive to thrive, but forgetting the thrive bit, then it's a bit of a road to nowhere. So this prioritization is a really difficult battle, and sorry to return to serious, but this is, I know, something that everyone's grappling with. Those points Dan made were actually legitimately true and and worthwhile remembering some of it.
Do you have a right of reply on the conservation side?
It equally pains me to agree with my moron of a colleague with some of the things he
We're
said.
not colleagues.
I think if we're exiting debate mode and
Well-
getting into reality mode, are we doing that yet?
Let's do that. End scene.
Okay.
We have
So-
a vote first.
Okay, Paul really wants
No, no,
to
no.
have a
Actually-
winner and a loser in this situation.
Paul, you win. Okay, you won the.
Yeah, go on.
Can we get a cheer for the growth mode argument and for the cash conservation wisdom? Oh, it's
The
fine,
people have
it's fine,
spoken.
It's fine. All right,
Um,
so we're gonna exit debate mode now. Everyone's free to actually share their real perspectives. I do have some questions. There are also some audience questions, and perhaps the most important one to mention first is the actual footage of Dan at the hare race was pretty damning. So thank you for that comment from the audience. So I guess just to think about the context of what we're in right now, as Paul, you were heading towards there, this is the thing that's on everyone's mind. You know, how much is a good amount to spend while also trying to extend this runway, for 15 years? Like what is the kind of next expectation where somebody will be able to raise on, and what should their growth metrics look like? So perhaps to kind of simplify that question, what metrics will investors be indexing on over the next 12 to 24 months when they are meeting startups? Maybe we'll go with Dan.
Yeah, so I mean, I think growth is always going to be an important metric, but I think, and this is not the debate mode, this is reality mode. 12, 18 months ago, it was just growth. I mean, Paul talked about sitting in ICs and no one saying, "Oh, we've been so excited about cash preservation." That's absolutely true. And the starting point that he mentioned is also true. Like we as investors get super excited about growth. You've got a high growth rate, something's going right. I would say for a long time, that was the most important metric by a mile. It was 80% of the focus was how are they growing, and then you ask why and what's going on. And so, is growth going to be important moving forward? Absolutely. But the health of that growth has become much more of a focus. What do the unit economics look like? What's your payback period? And again, for different business models and different business types, there are different things that we're going to look at. But the efficiency of your business is something that historically has always been important. In the last few years, has sort of disappeared a little bit from thinking with just this insane focus on growth that the market has had for the last 3 or 4 years. And so things around efficiency of the business, capital efficiency of the business, and with all things, these are incredibly nuanced. So depending where you are in your business, as a later stage focus, there might be, and I'm talking quite late. Certainly not where anyone in this room is investing, at this table is investing, but later stages, like what does path to profitability look like? Is there a path? And so there will be a fork in the road where I get to choose, do I go down profitability or do I keep reinvesting in growth? But is that choice in your hands or is it out of your hands because the path to profitability is not possible? So yeah, much more around health of the business starts to come in, but yeah, absolutely growth is still an important one.
And Jesse, you kind of, one of your major points there was scrappiness breeding creativity. I know you're sort of in the first generation of your time in VC, but do you think that spirit of scrappiness and creativity has actually been lost over the last kind of 24 months or so, where it has been much more of an optimistic bull market for VC?
Yeah, look, I think when there's a lot of pressure to grow because you've just raised a large round and the world's eyes are on you and you're hiring this big team, it puts a lot of pressure to adopt a playbook that another business has walked down. So, maybe a comparable business grew by investing in SEO and content marketing. So you go and hire some experienced SEO and content marketers, maybe from those very companies or similar, and you ask them to execute on the playbook that worked so well for that company. But you're doing that at the expense of finding a channel that really authentically resonates with you and the customers that you have really strong fit with, and finding within yourself something that resonates because it doesn't sound like the marketing that people are reading everywhere else. So I think that not having, the luxury or curse to go after somebody else's playbook actually gives you more time to define your own. And that can be something that actually resonates more strongly, or at least because it's more authentic, is something that you're able to carve out as your niche and the thing that you're known for.
Any shout outs or any startups that you think have done that particularly well through this period?
Ooh.
If it's, I know it's off the top of your head, only if something comes to mind. Oh, good. Okay, no worries. So Paul, I think it's really interesting to kind of juxtapose Dan's point there, or continue that thread. I guess my question is, when we are shifting the focus toward, let's call it sustainability rather than cash conservation, and yes, there may still be growth initiatives, but it's much more of a steady state for a little while as we see what that next kind of market change will be. Do you think that actually changes the DNA of a company to shift so far from the hypergrowth phase that we have been into? And is it something that they can recover from once conditions change?
I think it's very specific. I think this is this is potentially the golden period for Australia. I think if we think about where we are in the cycle, Dan's talked about sort of the macro cycle, but just within Australia, we haven't had sort of the elements of a strong and ambitious startup founder community, where being a founder and pursuing this high ambition is actually socially and professionally acceptable, and a venture capital industry that's prepared to back those dreams. That's fairly new in this country. So what we retain is a lot of the benefits that Jessie was talking about at a DNA level, at a cultural level, is have a sensible, sustainable business model. So the combination of those two things, a DNA which actually can easily adapt to growth based on a sustainable business model, we are one of the strongest ecosystems in the world at that. Now, it's still very small and it's still quite nascent, but we're really strong on that. So we've piled on this cash, and that's been really good because it's actually grown successful companies and it's grown the ambition of the community. And that venture capital still exists. Like every fund in the country is still sitting on a bunch of cash. So it's not going to zero invest, but we're going to do it in a way, this growth at all costs that Dan was talking about, that has gone away. But it's the at all cost that has gone away, not the growth. And so having been through a few cycles myself, we've seen that these cycles they take a long time to get back to the peak. But FOMO will return. It's the FOMO that actually drives a lot of the dangerous behaviors, because everyone's like, well, you'll see TechCrunch articles. How do you calculate payback periods? What does EBITDA actually stand for? The rest of the world's pretty good at forgetting that in hype cycles, and Australia's pretty good at remembering. And during the hype cycles, I remember I've spent a lot of my career in life in Silicon Valley going, oh, you arses, you're so stupid. And then we get a crash and go, geez, you guys are geniuses. And then, we boom again and we're stupid again. And so our DNA will sustain us really well through this period. And now that we add on the accelerants of venture, I think that we are in for a really exciting period.
Awesome. Justine, when Dan was interviewing Chris before, Chris made a really important point around, there were fires everywhere towards the end of last year. And what was actually a really good strategy for them was to pick that they could identify the one that was going to make the most impact. So it's not, again, growth at all costs, but it was actually spending money where it was really meaningful. What do you see in some of the later stage companies that One Ventures works with that demonstrates either that example, or perhaps where they are not judiciously spending money and creating, just leaking money out the door, basically?
Well, I think that's a classic capital allocation point, right? So you need to have some heuristics that you can use within your startup to try and evaluate what is going to be the biggest benefit to you. That might look like fostering short-term growth, but it might also look like, something I've been thinking about recently is like defensive versus offensive spending. And, if you're putting out a fire, which is going to mean that you are sustaining your business model for the long term and creating a strong, really cementing yourself in an existing market, that I would characterize that as more of a defensive spend than an offensive spend. And so I think, you need to be able to really deeply understand your market in order to understand what is going to have the best benefit to you and actually build economic value. And then that aside, I think Jessie's point about scrappiness breeding creativity is something that really comes back to the point around, this whole debate has been about the binary between conserving cash or generating growth. That can actually be decoupled. just because you are spending money, it doesn't mean you're spending money efficiently, as we've all mentioned. And just because you are implementing growth strategies doesn't mean it's costing a lot of money. I mean, you gave a great example, Jesse, around, your affiliate link, but there are other things you can do around pricing strategy and monetization of your existing SaaS product. We were having a conversation with a startup today around what types of features they give away in their free version versus their paid version. And those things alone can change the type of conversion and growth rate you experience.
That's a great answer. Thank you. We've got a little bit of time left. I'm going to jump to a few audience questions. We'll do some rapid fire. I'll try to identify the best person to answer the question. From Jimmy, can anyone give a high-level description of the idea of default alive versus default dead? Anyone want to jump in on that one?
Yeah, I mean, I'm happy to have a crack. I think being default alive is kind of that fork in the road that I was talking about before, where the choice is yours, whether you choose to either raise more capital or not raise more capital, but invest the capital that you have in future growth. But if that capital dries up, that you can preserve the business. So you can get the business to has a legitimate path to profitability, and that doesn't mean like, okay, we stop spending everything and we have to fire everyone, and hey, look, all of a sudden we're default alive. That's not default alive. That's default dead. Default alive is where, should capital dry up, you can make changes in your business where you can still service your customers, you can still continue to innovate, continue to build out your product, but you have cash flow and profitable, and that decision is yours.
Lee Jasper, co-founder of Aconex, CEO, he has a great expression. He calls it porpoising, which is sort of heading towards cash flow break even or profitability, raise some capital for a specific agenda, execute on that, which means burning, and then get the ROI on that and start returning to cash flow positive. And that optionality can allow you to run that porpoising path quite effectively.
Yeah, and if at this point the cash didn't come in, you still be remaining in business, that's default alive. If at this point the cash doesn't come in, you have to shut the doors, you are default dead.
And I think an important component of default alive is being profitable at the unit level. So if every dollar that a customer is paying you is actually losing you $1.50, then you can't grow without running down your runway. So that's an important, I think, milestone or inflection point for a business.
A question from Hugo. The brightest star burns twice as fast, nowhere truer than in tech. What is the panel's view on the kind of noise versus action in current market conditions? Are we hearing a lot about the right startups, or are they making other good ones going to ground? Justine, you have any thoughts?
I mean, it's a bit of a mix, right?
Yeah.
And it always has been. There have been companies that have left Australian VCs really chagrined that have managed to bypass the entire Australian VC landscape, head straight to the US, which, all to their credit. But I think, is it a problem? I mean, each individual startup is going to pursue, not everyone wants a noisy environment. I think it's more helpful if you're a D2C business or just generally a B2C business to be more noisy and get more PR in the market. Some enterprises have a bit more of a corporate image, especially if they're trying to target much larger, really mature, incredibly high-scale businesses. So it's not really helpful to them to necessarily be a rising star. And I will offer a counterpoint to that. We were speaking to a business recently where most of their customer base sits within kind of like a government/NFP space. And actually, for them, publicizing a huge raise would actually work actively against them. So I actually think it's really nuanced and individual to each business.
Makes sense. Paul, do you have something?
Yeah, I think this sort of hype gets a bit confused. Like, the discussion we were having earlier on, saying the ability to tell your story well and to pin your ambition out there is not, that's probably the darker side of our culture. We're not very comfortable with that. We don't like declaring an intent. When you can declare that intent, you can get advocates on your journey. And those advocates might be investors, employees, customers, other people spruiking your solution. So it's really powerful to get those advocates on your journey and to sell it forward, as long as you can backfill against the promise that you're selling. At the moment where you are overselling and you don't backfill, that's when allegations of fraud start coming in. So I think, again, like Justine was saying before, this is a very nuanced discussion. You don't have to go out and absolutely embrace tons of press and be a total media whore. That doesn't necessarily get you to where you want to get to, but it can. You just got to get the story right, be prepared to declare your ambition. That's okay when it makes sense, but make sure you're maybe just out over your skis, but not too far that you topple down the hill and over the cliff.
A framework that I use is don't go for noise, go for resonance. And the etymology of resonance is about when two things are making noise at the same frequency, they actually kind of start to vibrate in tandem with each other. So know who the audience or the customer that you're trying to attract with is, and resonate with them in a very specific way that generates a emotional connection to you, rather than making noise for the masses without knowing what you're trying to achieve.
I just want to add one thing, which is not specifically an answer to this question, but sort of touches on some of the things these other guys have been saying around, these answers are nuanced, or growth versus preserving cash. The argument can be decoupled. I think it's very clear that neither of these extreme views are the correct view. But what's even more important is the answer is somewhere in the middle, and that answer is going to vary depending on your business, on your industry, on your competitors, on your funders, on your product. There is no answer to this debate. There is no one size fits all approach. And some companies in this environment, it's going to be foot to the floor. Like, let's grow. The competitive landscape is so attractive now. We can outspend them, we can outgrow them. And for others, it's going to be the exact opposite, which is just like pens down. We absolutely needed to stay alive. Let's cut burn. And so that nuance of understanding your business, your industry, your competitors, your investors is really what's going to frame the answer to this bigger question.
That's a perfect place to leave it. I want to thank my incredible panelists, debaters. I know Paul wanted one more thing to say. Thank you. Thank you, Dan, Jesse, Paul, and Justine. I think there's been a wealth of information here. We could have talked for a lot longer. I think each of these people has great perspectives to offer. So please, with the questions that didn't get asked, try to find them before they step out. And of course, tune in for part 2, the jelly wrestle between Paul and Dan at some point in the future. Thanks very much, everybody.